Students, now we can discuss about the capital structure. Students, if you are going to start any business, generally we are taking a decision about how can I procure the capital. Do you want to use your own money for the business, or do you want to use the borrowed money? The borrowed means you are borrow the money from the banks or the private people. How we want to procure the money? In the financial terms, we are called it as a capital structure. Example, if you are taking money from the bank, you are paying interest on that loan. That we call it as a debt sources. But if you are taking or you are inviting your friend to join in your business as a partner, after 1 year after the business completed, you are going to share your profit. You are not paying any interest to your friend. That is called equity. I think you are very clear about the debt and equity. The proportion of debt and equity decisions we are taking under this capital structure. The capital structure includes the long term debt and total stockholders investment. I told the example. Here we can always try to maintain this optimum capital structure where that level we are the value of the company is also good. That is the very good the combination of the debt and equity. It will impact or enhance the market value of the share. Got my point? That is called working capital structure optimization. See, my students, on the screen, the source of long term working capital we can see on the screen like two: properties funds, our own funds, or the borrowed funds. The borrowed funds, we are borrow money from the outside people, or we are borrow the money from the banks. But in the property funds, we can again segregate in the three different ways, maybe equity capital or preference capital and reserve and surplus. Equity capital shareholders, they are having the voting right. The preference shareholders also, it's like similar to like debt source, like they are preferring for the some level of rate of return, and also you are using our own reserves and surplus. So these are the determinants of the capital structure. Why you use this criteria? Because these things only impact your capital structure decision. For example, that if there is any tax benefit for the debt, you are going to take the money. When you are generating the more profit, you can say that I am paying this much of interest to the bank, so that you are exempted from that. And also the flexibility also should be there. The flexibility, the changes of this debt and equity, it should be the flexible, because sometimes what happened, your depends on the whole total on the bank, but your family member or your trustworthy or your one of your best friend want to join in your bank, in your business, you can invite him as a partner, because we are paying lakhs of rupees in the form of interest, but where we cannot pay the interest, just we are sharing the profit to your friend. The next we can control, where we can control the expenses. That is also one criteria. Debt we cannot control, but if you are doing any partnership business or the shareholders, we can decide we are getting 10 rupees profit, 2 rupees we can keep it as a reserve amount, the remaining 8 rupees we can take our portion, or we can distribute our profit. So there is a controlling in the equity. And industrial leverage ratio is also one of important. Leverage means that we are using the fixed the portion of the funds for the business operations. And agency costs also, sometimes we are spending more money for the agencies for the development of the business, and the legal requirements is the one criteria where for example, if you want to go for the public offering or taking loan from the bank, there are the different formalities in the legal way. So we have to fulfill all those things. So sometimes what happened, if you don't want to time to do all those things, if you don't want to take up all those challenges, you can go for the simple way, inviting your friend to be a partner. The cost of capital is also one of the important, because in this the investors they are expecting the minimum rate of return. So, that is also one area we have to be concentrated. Thank you.